Well, how's it going, friends and family? My name is Amos, and I've made video after video breaking down the trade desk, ticker symbol TTD. And I finally put my money where my mouth is, and I went in pretty big. To articulate why I did that, take a look at your screen right now. If we jump on over to their balance sheet and we take a look at their cash position, right now they have $1.4 billion of cash on the books. To that, of how much debt do they have? The total debt is $375 million. So after accounting for all of the loans on the books, they have an excess of $1 billion of cash left over. And if we jump on back over to their income statement and we take a look at their top line in 2015, this is a company that was generating $113 million in gross sales. Now, if you fast forward to what it is in the trailing 12 months, it's $2.7 billion. You tell me, does that kind of growth not make your nipples sweaty just a little bit? Like, that is absolutely insane. Growing year over year at these types of numbers. Obviously, it's scaling off a little bit, and that's because they've penetrated most of the market, but it's still, nonetheless, growing 20% year over year. And this is the final cherry on top of why I had to pull the trigger. You zoom out past 5 years, they're at a 5-year low. Their current trading price at the time of making this video is $36 a share. By the time you watch this, they could be $35. They could be $37. However, at their highs, which was 2024 in December, so exactly about a year ago, $139 a share. But friends and family, it gets better than that. Believe it or not, there are so many more reasons as to why I pulled the trigger. Now, for the basic FAQs, I've already covered those in my previous deep dives on the trade desk, and I still think those are worth watching, especially if you want to learn about the business overview, how they generate money, their economic mode, and everything else. In this video, I'm going to focus specifically on why I decided to jump in, and I'm going to be giving you a revised update on their price target in regards to their stock price. If that sounds good with you, let's go ahead and get into it. So here's the cheese situation. I'm going to be articulating all of my arguments, okay? So number one, they operate in the open internet advertising business. So if you're trying to sell man bras because you're walking around with C cups, the trade desk will help curate your products on CNN, Disney Plus, Uber, Hulu, HBO Max, Paramount, Spotify, and even Walmart. And you best believe that Walmart's never going to use Amazon's advertising service because they don't want to share their customer data with their competitor. Does that make sense? If you're Walmart and your rival is Amazon, why would you ever want to use their advertising service? Right? You're going to go to someone who's more neutral, someone that caters towards the open internet, not in walled gardens. And here's another reason why I decided to jump into the trade desk. 2026 is a major election year in the US because it's the midterms. Since we aren't electing a president for another 3 years, the entire focus shifts to who's going to control Congress. If you're not a US citizen, it's basically a high-stakes battle to see if the president keeps a path to pass laws, because right now it's a Republican domination across all 3 sectors, right? You got the House of Representatives, the Senator, and the president. They're all Republican. Now, I'm sure they're going to want to keep that type of power, right? Because otherwise, if there's more Democrats that come into service, then they're going to block their bills and the stuff that they're trying to achieve. So because the stakes for the next 2 to 3 years are so freaking high, dude, you can expect your social media feed to be absolutely flooded with campaign ads. On Facebook, Instagram, TikTok, your Zynga, your MySpace. The budget for campaign ads going to be through the roof. You can quote me on that. The trade desk will directly benefit from the midterm elections. And you know what else is happening in 2026? The World Cup. That's going to be hosted by the United States, but also with our little partners, Canada and Mexico. And that's something that only happens every 4 years. And what makes this World Cup different from the others is that, as you can see on your screen right now, there's a lot more qualified teams that are going to be playing for this competition cup, which means there's more skin in the game for all the people around the world. More people putting their eyes on the screen means the advertising budget for FIFA going to be through the roof. Who's going to benefit from that? The trade desk as an advertising platform. Me personally, I'm going to be rooting for USA in Group D. I know it's a hot take, but I think they're going to come out on top as number 1. I think Australia is going to be number 2. I know Paraguay sometimes can be good, but I think they're going to be number 3. And then obviously the playoff, we don't know who's the number 4th team for this one. And then my secondary team that I'm going to be supporting ethnically, I'm Korean. I know sometimes you guys think I'm Nigerian, Vietnamese. No, I'm actually Korean. So in Group A, I'm going to be supporting South Korea. This one right here is a tough group because I think Mexico or South Korea could come out on top. But regardless, I don't think South Korea will go 3rd or 4th. Worst case scenario, I think they'll be in 2nd place. Best case scenario, I think they'll be in 1st place. With the form that Mexico is playing in right now, you know what I'm saying? Historically, they are a pretty good team, but their defensive situation, their midfield situation, and they don't have good chemistry on the field right now. And here's another reason why I decided to jump into the trade desk. At their most recent earnings, Q3 of 2025, they announced that they were going to do $500 million of additional share buybacks, which means if there's 100 shares outstanding, they're going to be buying back like 5 of them, and now there's only 95, which is going to financially engineer your bottom line per share to look better than it is. It's just a good thing all around. And why are they doing that, Amos? Because the leadership team believes that their stock price right now is just way too low, and I agree with them. So to pull the trigger and to be deploying all that capital to buy back the shares, huge fan of. And the next reason is a common argument as to why people dismiss the trade desk. When you take into account some of their peers like Amazon, right? For instance, their forward trading multiple is a 29.8. Their trailing 12 months PE ratio is a 31.4. If we do the same thing with like Microsoft, their forward trading multiple is a 28. If we do Google, their forward trading multiple is a 28. And when it comes to the trade desk, listen, I know the trailing 12 months says 41.6, but their forward trading multiple, which is if you divide their share price of $36 per share by next year's estimated earnings per share, then it's an 18.6. Listen, pal, when it comes to a growth company, your wife's boyfriend told me not to look at the trailing 12 months PE ratio, but instead the forward trading multiple, because then you strip out a lot of the one-time accounting noise and it gives you a more accurate depiction of their current valuation. They're not truly a 41 PE company. An 18.6 is what they are based on their share price. Now, if they were to trade at about like a $50 per share, then obviously their forward trading multiple would be closer to that of their peers that are also executing numbers like they are. I think for the numbers that they pull off, just to show you, look at their bottom line per share, also known as the earnings per share. For the numbers that they are pulling off, I think they're really cheap right now. To have a forward trading multiple of an 18, dude, I remember exactly 1 year ago. You can fact check me on this right now. Pause this video, go to my YouTube channel. I said the exact same thing about AMD and NVIDIA. AMD's PE ratio at the time was like 140 or something, but their forward trading multiple was like a 21. And I kept articulating that for a company that's at the tip of the spear of the AI movement, they are cheap. I'm putting all my money into them. And now when you pull up AMD, their forward trading multiple is a 37, which I think is more appropriate for a company that's supplying the AI data center movement. About a year ago, they were absolutely undervalued. It's the exact same thing that I see with the trade desk, because the numbers that AMD were pulling off, it reminds me of the trade desk as well, right? And the next reason as to why I jumped into the trade desk is their customer retention rate. As you can see on the screen right now, it's over 95%. Now, to put it into perspective, Costco's membership renewal rate is 90%. Now, obviously, Costco is a B2C model, whereas the trade desk is B2B, but I think the point still stands. As a business enterprise, would you continue using the trade desk that charges higher fees than Google and Amazon if it didn't actually pan out? If you were losing sales and your marketing campaigns were a flop, would you consistently use the trade desk? Obviously not. 95% speaks volumes to the quality of their product itself, their platform, and even though they're fighting, it's like David and Goliath. Even though they're fighting against bigger fish in the sea, they're standing their ground, and their numbers are proof in the pudding that they're thriving, that they're succeeding. Their share price do not match the financials and fundamentals of how successful the trade desk is right now, and that's why I'm gonna go on record by saying they're undervalued. Now, obviously, I could be wrong. I have small feet, I'm stupid, I shower naked, and I use a bicycle instead of a car, so I'm all kinds of jacked up and stupid. This is not financial advice, but I truly think on paper, they're undervalued. It doesn't mean that they're gonna amplify and 2 or 3x. Sometimes a company can be undervalued and stay undervalued. Shout out to you, PayPal. Dude, your financials and fundamentals are rock solid, like bam. However, the stock price, you know what I'm saying? You're undervalued and it's not growing. And to be honest with you, that has to be beyond frustrating if you're an investor of PayPal, because I truly think they're high quality, but the stock price is absolutely dirty, caked up, muddy butthole. It's just, And my biggest reason as to why I think the trade desk is undervalued, I'm a numbers and data kind of guy. So let me just show you what I'm talking about. Let's jump on over to their inherent worth calculation. Now, before I get into it, I've got to talk about this and I want to address it because I think some people are genuinely upset about how my hands are moving in the video. And I don't know what to tell you because the hands have opinions. I'm a weird guy. I can't help the fact that my face is Korean, but I was born with Italian hands. This is the way that I am in real life as well, right? I'm a very animated, energetic. I'm the kind of guy like, I hug you. I'm like, dude, what's up? I'm not the kind of guy that like bows and it's like, oh, shit, thank you, konnichiwa. No, dude, I'm like, dude, bring it in right here. I'm a pretty warm, friendly kind of guy, right? That's just the way that I am. And you want me to tie my hands behind my back? Like, dude, come on. However, I will say this. Yesterday, I did get the flu vaccine because I have a 9-week-old here at home, and the pediatrician was giving me a lecture about how like we need to get vaccinated so that we don't pass anything off to the young ones. And I was like, all right, whatever, I'll get my jab. So I got it done, and I'm feeling it. I have a slight headache, fever. So between you and me, I think that'll bring down the scale and make the hands underperform. I don't think they'll have a compounding effect anymore. I think their CAGR is going to be reduced from like Italian Napoli to like that nervous intern that's giving their PowerPoint presentation, okay? I think it's gonna be a little more muted. And to be honest with you, if the hands offend you, I mean, I'm like a tiny little square on your screen, right? It's not like I'm taking up the entire thing or I'm walking around with my dong hanging out. Like then I'd be like, all right, maybe I'm being a little too much, but the hands moving around, I mean, come on, cut me some slack, all right? And believe it or not, in one chapter of my life, I used to be a pastor, so when I used to throw down the sermons, I think that's also another reason why I incorporate so much movement and animation. And the fact that I used to be an infantry officer, and so when you give briefings or you tell the mission or operation to your platoon, obviously you don't want to be the kind of guy that just goes, hey guys, today the operation order is blum, 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 and we're gonna hit the target by 1200. So all you guys jerk each other off in the back, on my command and call, you're gonna be coming up and supporting us in the flank. You see what I'm saying? Like, it's just, I guess all of my various careers, this is who I am, and I'm so sorry. But anyways, what you see on your screen right now, this is something that I've been working on for the past 3 weeks, and I think it's finally good to go. It's an intrinsic valuation calculator based on future revenue growth. Yes, I took a lot of inspiration from the discounted cash flow analysis model, which is predicated upon the free cash flow. But sometimes, when it comes to a company, I think it's better to just go off of their top line and their profitability. And that's why I created the Amos GARP formula. And I think it makes a lot of sense. I've been poking holes in it, doing a lot of A/B testing, and it's finally good to go. And because I created this bad boy, I'm gonna be featuring it a lot in upcoming videos. If you want to play around with it yourself, I will be posting it onto the Patreon. So having said all of that, what is the cheese value per share for the trade desk as of right now? These should realistically be $54 a share. So they're $20 below that, okay? Now, the price that I would pay, I like having a margin of safety baked in just to add a little bit of cushion and protection for my own sake, okay? So the price that I would pay is $39.91. Unfortunately, I was not able to time it perfectly, so my average cost basis, which I will share with you here in a little bit, is a little bit higher, but $39.91 is a good price to acquire the trade desk. That's not financial advice, that's just what one idiot thinks. When it comes to the compounder chart, am I going to adjust their position? No, I'm going to reiterate that I think it's a really good, high-quality compounder that's beat up because of the uncertainty with the advertising landscape. I think there's this big narrative that Amazon and Google is going to come out to eat their lunch and poop all over their work desk. But the facts are, the numbers, they suggest otherwise, right? And that's why I think the same with Adobe. I don't think that AI is ruining them. I also think these three right here, I think they're all just getting beat up, and I think it's a really good opportunity. Adobe, the Trade Desk, Oracle, all three of them are a C+. C+, meaning it's not my highest conviction and my strongest feelings for who are going to be the outperformers in the future, because that's going to be given to Google and Amazon. But at a C+, I still think these are really good deals. Now, having said all of that, let me share with you my position on Snowball. Let me just zoom in to make it a little more friendly for you guys. I have 65 shares of the trade desk. I spent $2,700, and right now the current valuation, $2,381. I'm down 12.2%. So my average cost basis per share is $41.75. Like I said, I really wanted to buy it at $39.99. And even if I did buy it at $39.99, I would still be in the red because they're currently like $36, $37. So that's what we're working with. And as you can see, the trade desk, they make up 3.6% of my portfolio, so it's not my highest conviction nor my strongest position. But I believe in the trade desk. I think it's going to be a compounder. I think they're just one solid positive news away from skyrocketing back to 50, 60, 70 bucks. I mean, this is a very volatile stock, right? Let me just show you what I'm talking about. If we pull up the trade desk on stockanalysis.com, by the way, I have a referral link down below. If you sign up using that, you get the discount on top of whatever promotion they've got going on. If we zoom out past 5 years, this is a stock where, unfortunately, it's not a buy and hold for me. Because as you can see, advertising is a very cyclical industry, right? There's highs and lows depending on the market cycle. Sometimes they go really high up, like $107 a share, and sometimes they go really low. This is a game that the trade desk has been playing for the past 5 years consistently, right? After they reached their very high, they went on a massive sell-off to 46 bucks, and then they rebounded to like 86 bucks, and now they're on their next little sell-off. You scroll back and take a look at their history. This is just what happens with the trade desk. They go on these highs and lows. So for me, I don't think it's a buy and hold. But when you take into account, since their IPO, September of 2016, up until today, to be 1,174% in the green, I think that's a really good ROI. And that's why I'm not afraid to say that they are a compounder. It's just right now, they're in a pretty bad pickle. And I want to address one more thing, right? I think there's some people that are just so fixated on the fact that they have stock-based compensation. And if you're a friend of the channel, then you know I'm a huge fan of stock-based compensation, because then it aligns the priorities of the shareholders to that of the employees. Because if a lot of your compensation is predicated upon the stock price doing well, which is based on the company's operations thriving, then everybody wins when the stock price goes up, right? So I personally like it, but fundamentally, on a numbers level, it does break down the free cash flow because it erodes the free cash flow, right? So the stock-based compensation, let's address it. It's going from $374,000 of RSUs given to new hires or even the end of the year bonus. You fast forward to today, $500 million of stock-based compensation in just the past 12 months. That's a lot. So because you're giving stock-based compensation, that's also going to dilute the shareholders because now there's more shares outstanding. But what I want to say to that is if you take a look at the shares outstanding situation, because of the stock-based compensation, you would think that it's skyrocketing, right? It's not, because they're buying back the shares. It's relatively flat at roughly like 499, 500 million shares outstanding. So the number of shares is pretty much flat. And even though it's a company that has a crap ton of stock-based compensation, they're not alone. Every major tech company, I know for a fact that Google gives you a crap ton of RSUs, right? I have friends that work at Google, and if you take a look at their stock-based compensation, it's freaking $23 billion, right? This is not something that's unique to just the trade desk. If you are a high-growth tech company, stock-based compensation, it's just the name of the game. That's one way to compensate your employees. And it's a lever that the employer uses so that you don't jump ship too soon. I know for like Amazon, if you want your RSUs to vest, you have to stay at least 5 years. Actually, let me just correct myself. My memory's a little fuzzy, but I think it vests in a cliffing period. Like a little bit of it vests in 3 years, a little bit invests in 4 years, and then it fully vests after like 5 years. But they do that so that you don't jump ship. Because as a former manager, I think the continuity of a team's output and projects, it really depends on the chemistry, but also the team members being consistent. If you have people that are jumping ship after like 6 months consistently, dude, that just sets you back so much. So to keep the same people in your team quarter after quarter, it allows you to be more laser focused on whatever it is that you're trying to achieve. And that's why there's stock-based compensation. And that's from corporate America's point of view, right? So their free cash flow should be trash, right? Based on their stock-based compensation being so high. No, it's not. It's growing 30% year over year. But I will admit, if they didn't have so much stock-based compensation, their free cash flow would be easily $1.2, $1.3 billion. But because of the stock-based compensation, it is eroding the full potential, which means the growth rate of the free cash flow would be a lot higher. So in one sense, I think the trade desk would be a good place to work for because you're getting a crap ton of stock-based compensation. But as a long-term investor, you might be a little offended and annoyed, and I think that's absolutely valid. Now, speaking of long-term investor, I'm going to reiterate it one more time. This is not a company that I plan on holding forever. Now, obviously, I'm in the red by like 12%. But once they rebound, which I know they will, right? 2026 is a huge catalyst year for the advertising market and platform and landscape. I'm selling. I'm thinking after like a 20, 30% rally and pop, I'm out. So friends and family, there you have it. That's my case for why I decided to go in big to the trade desk. Now, obviously, some of you have like millions of dollars and you're probably like, dude, you went in big? What are you talking about? As a guy that makes like $300, $400, sometimes $500 a month, for me to invest $2,800 into a single stock, that's a lot, right? It's all relative, right? Some of you guys out here, you're super rich. So for you, going in big is like 2 million, 3 million. But for me, I think when we get north of 1,000 or even $2,000 into a single stock, I think you're talking big. But more importantly, let me know your thoughts and opinions on the trade desk. Do you think I'm screwing myself over? Do you think this is a bad judgment call on my end? Because I don't know, man. The financials and fundamentals look really good. But who is to say that they're not going to be the next PayPal, right? Because I think PayPal really breaks my heart for you guys that are invested into it because, like, their fundamentals are also just as good, but their stock price has been flat for the past 5 years, right? Let me see if I can zoom back 5 years right here. So they're $61 a share and roughly, actually they're negative 72% in the past 5 years. So it's a stock that's just horrific as an investment, but the financials and fundamentals look really, really good. Okay, so I feel for you guys. Before I sign out of here, I wanted to loop you in on some of the stuff that's going on off the screen. So I finally got around to watching The Dead Poets Society. Dude, that movie is like almost 40 years old, right? It's a Robin Williams film. And man, after I got done watching it, dude, I was just really sad. It's just that empty feeling, right? It put me into a pretty dark headspace. So if you're someone that's prone to depression or anxiety or stuff like that, I wouldn't recommend you watch it. But I can see why some people categorize it as like a classic film, like one of the top 10 films of all times. For me, I don't think I can give that kind of award Dude, I thought it was kind of dark and tragic. Not in the Shawshank Redemption kind of way, where that one is like a feeling good, like, wow, justice. This one is more of like, it just like rips your soul apart and makes you feel sad. Or at least it did for me. But I get the message, right? I think the message of the movie is loud and clear. But if you haven't watched it already, dude, I can't wholeheartedly recommend it. However, on the other hand, I also finally got around to watching Good Will Hunting, and my goodness, is that a movie masterpiece. Now that one, I would give a 10 out of 10. I would watch it again. Speaking of which, that's another Robin Williams movie. I don't know what it is. I watched 2 Robin Williams movies back to back. So if you can't tell, I guess I'm catching up on the classics because, I don't know, I never really paid too much attention to the movies from the 80s and the 90s, but dude, they're so freaking good. I also finished The Sixth Sense about like a month or 2 ago. Dude, that is so good. That's the movie where the little kid is like, I see dead people. Dude, that movie, so freaking. If you're a fan of plot twists where you can't tell what the heck is gonna happen next, dude, that movie is right up your bumhole. It is so freaking good. Now, the next movie that I plan on watching is another classic, and it's The Big Lebowski. And apparently that one is pretty good, so that's what I have going on. And in about an hour and a half, I need to take my daughter to a pediatrician appointment, so that's what I've got going on. Anyways, love you guys. Thanks for hanging out with me. Good luck in the stock market. Stay safe. And I mean it when I say that, because I've been watching the news of what's happening in the US, dude. There's a bunch of crazies out here, so you know, have some situational awareness. Look behind you every now and then, especially if you're in a dodgy part of the town. Take care of yourself, please. And good luck. And I will talk to you guys really soon. Peace.